Hey everyone, ready for another deep dive? This time we're tackling investment tools for 2024. We got a listener request for this one, sent over a whole stack of research.
Absolutely, and it's a good one. Everyone wants to know the best ways to grow their money, right?
Definitely. But we're not just going to rattle off a list, we'll break down the pros and cons and why these tools are considered top picks for this year.
That's key. It's one thing to know what the options are, but understanding how they work, the strategies behind them, that's where the real power lies.
Exactly. Informed decisions, not just following the hype. So, before we get lost in all the different options, let's take a step back. When we say investment, what are we really talking about?
At its core, investing is putting your money to work. It's not just about saving, it's about making your money grow over time.
Okay, so like planting seeds for the future, but with your money.
You got it. And like any good garden, it takes time, strategy, and, well, a bit of that green to get things growing.
Makes sense. And speaking of time, there's that famous Warren Buffett quote, right? Someone is sitting in the shade today because someone planted a tree a long time ago.
He nailed it. Investing is all about that long-term vision. It's about the decisions we make today to shape our financial future.
So no get-rich-quick schemes here, more like building a solid financial foundation, brick by brick.
You got it. It's about making smart choices that will pay off down the road.
Gotcha. So let's talk about those building blocks. What are some of the assets people usually consider?
Well, a popular one that always comes up is stocks. Buying stock is like owning a tiny piece of a company.
Okay, so instead of just watching the stock market go up and down, you're actually becoming a part owner, even if it's a small part.
Right, and the hope is that the company does well, the value of your stock goes up, and you benefit from those gains.
But there's got to be some risk, right? We've all heard those stories about the stock market crashing and people losing money.
Absolutely, no investment is without risk. And stocks are definitely known for their volatility. The prices can fluctuate quite a bit, and yeah, there's always the possibility of losses.
So how do you navigate that? How do you know which companies are worth investing in?
That's where research comes in. Like Peter Lynch, the famous investor, said, before you invest in a stock, you must thoroughly understand the company behind it.
Meaning you wouldn't buy a house without inspecting it first.
Yeah.
You got to look under the hood, so to speak.
Exactly. You want to understand the company's financials, their business model, what their competition looks like. All those factors matter.
So it's like being a detective, gathering clues to figure out if a company's a good investment or not.
That's a great way to put it. Speaking of investments you can really see, let's move on to real estate.
Real estate. It's tangible, something you can actually touch and feel. But isn't that a totally different ballgame than stocks?
It is different, but it has its own set of advantages. Think about it. You could generate rental income if you lease out the property, and there's always that potential for the property to appreciate in value over time.
So you're benefiting from both the income and the potential growth? Sounds pretty sweet.
Yeah.
But what are the downsides? Isn't real estate a huge investment up front?
You're right. The initial costs can be significant. You have the down payment, closing costs, and then the ongoing expenses like property taxes and maintenance.
So it's not as simple as just buying a property and watching the money roll in.
Yeah.
It takes patience, right? Like we were saying about that long-term vision.
Absolutely. Like Robert Kiyosaki, the author of Rich Dad, Poor Dad, said, buy real estate, wait, and let the property work for you. It's a long game for sure.
It's about playing the long game with all these investments, isn't it? Whether it's stocks or real estate.
You're catching on. And that brings us to another classic asset, one that's been considered a safe haven for centuries.
Gold.
Gold. It's like the ultimate symbol of wealth and stability. But is it still a relevant investment today? It definitely has its place. Gold has this historical track record of holding its value, especially when economies get shaky or currencies fluctuate. It's often seen as a hedge against inflation, when the value of the dollar goes down.
So when everything else seems uncertain, gold is like that steady rock that people cling to.
Pretty much. But it's important to note that while gold might provide stability, it might not offer the same high returns you could get with, say, stocks or real estate.
So it's a trade-off, right? Less risk, but potentially less reward. Kind of like picking your battles in the investment world.
Exactly. And that brings us to a really crucial concept in investing: diversification.
Diversification. That's a word you hear a lot when it comes to investing. But what does it actually mean in practical terms?
Think of it like this. You wouldn't put all your eggs in one basket, right? Same goes for your investments. Diversification is all about spreading your money across different asset classes.
Okay, so not just stocks, not just real estate, but a mix of different things.
Exactly, because different assets tend to perform differently at different times. So if one investment takes a hit, the others can help cushion the blow.
It's about creating that safety net so you're not completely wiped out if one investment goes south.
Exactly. It helps manage risk and smooth out those ups and downs that are inevitable in the market.
Makes sense. So diversification is one piece of the puzzle. What else should people be thinking about when crafting their investment strategy?
Well, another key factor is understanding your own risk tolerance. How comfortable are you with the idea of your investments fluctuating?
Risk tolerance. So, some people are okay with big swings in their portfolio, while others prefer a more steady ride.
Exactly. Some people are thrill seekers. They're drawn to those high risk, high reward investments. They're not afraid to ride the roller coaster, so to speak.
Adrenaline junkies of the financial world. But not everyone's wired that way, right?
Definitely not. Others prefer a more conservative approach. They prioritize stability, knowing that their investments are safe and sound, even if the potential for big gains is lower.
So it's all about finding what fits your personality and your goals, right?
Yeah.
No one-size-fits-all approach.
You got it. Your risk tolerance can also change over time, as you get closer to your financial goals or as your life circumstances change.
It's all about adapting and finding what works for you at different stages. But let's be real, all this investing talk can feel a little intimidating. Where do you even begin?
That's a fair point. There's a lot to learn, but knowledge is power, especially when it comes to investing.
So don't just jump in blindly. Take some time to educate yourself before diving into the deep end.
Exactly. Arm yourself with information. Read books, articles, financial reports, follow industry blogs. There are tons of resources out there.
And don't be afraid to tap into those human resources too, right? Talk to financial advisors, mentors, even friends or family members who have experience with investing.
Absolutely. Learning from others' experiences can be invaluable. Now let's talk about one area of research that can be super helpful, even though it might seem a bit daunting at first. Financial statements.
Financial statements, those sound pretty dry and complicated. Why should someone care about those?
They might not be the most thrilling read, but think of them like a company's report card. They give you a snapshot of its financial health, how profitable it is, how it's performing overall.
Okay, so it's about looking beyond the surface, digging a little deeper to understand the real story behind the numbers.
Right. For example, a company might be reporting great profits, but if its cash flow is weak, that could be a red flag.
So you really need to look at the whole picture, not just focus on one or two shiny metrics.
You got it. Learning how to read and interpret financial statements can be a game changer. It empowers you to make more informed decisions based on solid data.
Okay, you've convinced me financial statements are going on my research list.
Right.
But what about the psychological side of investing? How do you deal with the emotional roller coaster of watching your investments go up and down?
That's such an important point. It's easy to get caught up in the excitement when the market's booming or panic when things take a downturn. But successful investors, they have this discipline, this patience, and this ability to control their emotions.
That's like having an inner Zen master guiding your investment decisions, not letting your emotions run wild.
Exactly. You need to stick to your plan, even when things get bumpy.
Easier said than done, right? Especially with all the noise out there, the news headlines, the social media frenzy. It's easy to get swept up in all that.
Absolutely. So surround yourself with positive influences, whether it's books, podcasts, mentors, people who reinforce sound investment principles.
So it's not just about numbers. It's about having that right mindset, those healthy habits that will help you navigate the market's ups and downs.
Right. And speaking of ups and downs, let's talk about market cycles. Think of them like the tides, constantly ebbing and flowing. Markets tend to move in cycles, alternating between bull markets where prices are rising and bear markets where prices are falling.
Okay, so bull market is like party time, everyone's feeling good, while a bear market is more like batten down the hatches, things are getting rough.
That's a good way to put it. And while it's impossible to predict these cycles perfectly, understanding how they work can definitely help you make more informed investment decisions.
So how do you know where we are in the cycle? Are there any signs to look out for?
There are economic indicators and market-based indicators that can give you clues. During a bull market, you typically see strong economic growth, low unemployment, rising corporate profits, and yeah, investors are more confident, willing to take more risk.
And then when things start to slow down, maybe unemployment ticks up a bit, corporate profits dip, that's when the bear market starts creeping in.
Exactly. And it's important to remember that these cycles are a natural part of the market. The key is to not get too caught up in the emotions, whether it's the euphoria of a bull market or the fear of a bear market.
Stay calm, Stay the course, that's the mantra.
Exactly. Now, let's talk about a strategy that can help you navigate these market cycles and potentially reduce your risk. Dollar cost averaging.
Dollar cost averaging, that sounds intriguing. Break it down for me.
Instead of investing a lump sum all at once, you spread your investments out over time, investing a fixed amount at regular intervals, regardless of what the market's doing.
So if I want to invest $1,000 in a specific stock, instead of buying all the shares at once, I could invest, say, $100 every month for 10 months.
Exactly. That way, you're buying more shares when the price is low, fewer shares when the price is high, and over time, it averages out your cost basis, potentially reducing your overall risk.
It's like shopping for groceries when they're on sale, right?
Yeah.
Stock up when the price is right.
Exactly. It's a great analogy. Dollar cost averaging can be particularly effective for long-term investments like retirement savings.
This all makes sense, but it's a lot to digest. With all these strategies and approaches, how do you choose the right one? Is there like a secret formula for investment success?
I wish there was a magic formula, but there are some fundamental principles that can guide you. First and foremost, remember that investing is a marathon, not a sprint.
Slow and steady wins the race.
You got it. Patience is key. Avoid those get-rich-quick schemes. They rarely pan out. Wealth is built over time through disciplined investing.
It's like building that house brick by brick, right? Consistency is key.
Absolutely. And second, embrace the power of compounding. Even small amounts, invested consistently over time, can grow significantly thanks to compound interest.
Compound interest? That sounds familiar, but I'm not sure I fully grasp it.
Think of it like a snowball rolling down a hill, gathering more and more snow as it goes.
So my money's the snowball, and the interest it earns is the extra snow it picks up along the way.
You got it. The longer you let it roll, the bigger it gets. That's why it's so important to start investing early, even if it's with small amounts.
Time really is money in the investment world, huh?
Absolutely. And finally, never stop learning and adapting your strategy as you go. The investment landscape is constantly changing, so stay informed about market trends, economic conditions, things that could affect your investments.
So it's not a set it and forget it thing. You got to stay engaged and adjust your sales as needed.
Exactly. And hey, don't be afraid to seek guidance when you need it. Financial advisors can be super helpful.
So it's like having a coach in your corner helping you navigate the investment world.
Exactly. They can provide personalized advice and help you create a plan that aligns with your goals and risk tolerance.
Okay, I think I'm starting to get the hang of this. From diversification and risk tolerance to understanding those tricky financial statements, we've covered a lot of ground.
And we're just getting warmed up. In part 3, we'll dive into some alternative investment options that you might find really interesting.
All right, welcome back. Ready to explore some of those alternative investments you mentioned?
Let's do it. Let's talk crypto. I'm sure you've heard of Bitcoin and Ethereum.
Oh, yeah, definitely. But to be honest, it all still seems a bit, I don't know, mysterious. Is it really something the average person should be investing in?
It can be, but it's definitely not for everyone. It's important to go in with a clear understanding of the risks. Crypto is known for being extremely volatile. Prices can swing wildly, making it high risk, high reward.
So not exactly for those who prefer a smooth ride, huh?
Yeah.
What are some things people should consider before jumping into that world?
Research is crucial. Understand the technology behind the different cryptos, their purpose, the potential downsides. There's also a lot of regulatory uncertainty surrounding crypto, so staying informed on that front is important.
Sounds like you really need to do your homework. No jumping in head first.
Exactly. And as with any investment, never put in more than you can afford to lose. The crypto market is still relatively new, lots of unpredictability. Caution is key.
Makes sense. What about something a little more, well, traditional? Like retirement plans? Those seem like a pretty safe bet for the future.
They are a crucial part of any long-term financial plan, that's for sure. Retirement plans like 401ks and pension schemes are designed to help you build that nest egg for your later years.
But I'm only in my 30s. Isn't it way too early to be worrying about retirement?
It's never too early to start. The sooner the better, actually. The more time you give your investments to grow, the better, especially with the magic of compounding.
There's that snowball analogy again. Get that snowball rolling early. It just keeps getting bigger.
Exactly. And with retirement plans, you often get the added benefit of employer matching. That's essentially free money. Your employer might match a certain percentage of your contributions, giving your savings a nice boost.
Free money. Now, that's something I can get behind. But there must be some downsides too, right?
The main one is the penalties for withdrawing funds before retirement age. They're meant for long-term savings, so you need to be comfortable locking your money away for a while.
So it's about finding that balance, making sure you have enough accessible savings for now, while also planning for the future.
You nailed it. Now let's hop over to a more global option. Foreign exchange, or Forex for short.
Forex. Isn't that all about trading currencies? Dollars, euros, yen. Sounds pretty intense.
It can be, but it's also a very liquid market, meaning you can buy and sell currencies quickly. It can be attractive for those looking for short-term gains.
But currencies are constantly fluctuating. Seems like it could be a wild ride.
It definitely can be volatile. Global events can have a big impact on currency values. A political shift, an economic crisis, even a natural disaster on the other side of the world can send ripples through the Forex market.
Sounds like you need to be on your toes.
Definitely. Staying informed about what's happening globally is key if you're considering Forex. Now, how about something a bit more stable? Let's talk bonds.
Bonds, okay. Those always seemed a bit mysterious to me. What are they exactly?
You can think of bonds as loans you're giving to governments or corporations. You lend them money for a set period, and they agree to pay you a fixed interest rate.
So, kind of like being the bank, but on a smaller scale.
Exactly. And bonds are generally seen as a lower risk option compared to things like stocks or crypto. They offer more stable, predictable returns, which can be appealing to more risk-averse investors.
But lower risk usually means lower reward, right?
That's generally the trade-off. While bonds provide a steady stream of income, the returns might not always keep up with inflation. They might not be the best option for aggressive growth.
Okay, so bonds are more about preserving your capital and generating that steady income stream rather than chasing huge gains.
You got it. Now, after exploring all these options, the big question is, how do you choose the right ones for you?
That's the million-dollar question, isn't it? There are so many options, so many factors to consider. Where do you even begin?
It comes back to those core principles we talked about earlier, understanding your financial goals, your risk tolerance, and of course, doing your research.
So if someone's goal is to buy a house in a few years, they might choose a more conservative route, focusing on things like bonds or high-yield savings accounts.
Right. But if they're planning for retirement decades down the line, they might be more willing to take some risks with stocks, maybe even a little bit of crypto.
It's all about tailoring your strategy to your specific situation and goals.
Absolutely. And don't forget about diversification. No matter what your goals are, spreading your investments across different asset classes is always a good idea.
Don't put all your eggs in one basket, right? Spread that risk around.
You got it. And hey, if it all seems overwhelming, remember that financial advisors can be a great resource. They can help you build a personalized plan that fits your needs.
It's like having a guide in the financial jungle, helping you find your way through all the twists and turns.
Exactly. So, as we wrap up our deep dive into investing, just remember this. Investing is a journey, not a destination. There will be ups and downs along the way. But by staying informed, being patient, and sticking to your plan, you can achieve your financial goals.
This has been an incredibly informative deep dive. I feel like I have a much better grasp on the world of investing now, and I'm sure our listeners do too.
It's been my pleasure sharing these insights with you all. The key is to never stop learning and growing. Keep exploring those different options, keep asking questions, and keep investing in your future.
Wise words. Thanks for joining us on this investment journey. Until next time.